who are you competing with in your service offering, and how unique your offering is in the competitive dynamic, and who else is out there that does what you do. And also an important element of competition is the competition in the actual M&A process itself. And that sort of blends into the final point, the uniqueness of the service offering or your skill set. I mean, it's very important to understand, and we do a lot of work with our clients understanding where they sit in what they do that's different than anybody else. And if you're, when we're working with a client to help find an M&A outcome for them, a lot of the work we do in the materials that we prepare and the scripts that we prepare and the dialogue that we have with potential buyers is about this component, about the uniqueness. So it's very important to understand that. And sometimes the perspective on that can come from us, and sometimes it can come from the management team and the owners of the business themselves. I mean, I think the founder, owner, and executive leadership of a client business is typically the best source of perspective on how unique the service is. So I'd like to talk through really 4 potential outcomes, 4, if you can think about it, 4 sources of funding or 4 categories of buyer. And the first is what's called a trade buyer, also referred to commonly as a strategic. So what is a trade or strategic buyer? It is really a competitor or a potential competitor of yours in the marketplace. So it's an operating company who really does what you do. That's when we talk a little bit later, we'll differentiate that from the financial buyer. But a strategic buyer is really somebody who's in the market, in the business, servicing clients just like you do. And so what makes them, really what's driving their interest in doing acquisitions? Well, it's very specifically the desire to get bigger and better. As you know from growing your own consulting business, it's difficult. It's hard to grow by finding new clients or growing new service offerings or hiring new people. It's growth is always difficult. It's always a challenge, and it's growing is very different from when you're 10 million versus 50 million versus $1 billion in revenue. So the trade or strategic buyers are very focused on growth. Obviously, the larger ones have all sorts of different stakeholders that mandate growth, and growing well and quickly and predictably is a primary driver of acquisition activity. The other is really just expanding what they do and expanding their expertise and their relevance to clients. It's very clear as the outsourcing dynamic in the global economy accelerates and becomes more entrenched. There are more and more areas of specific expertise that companies don't want to develop themselves. I don't mean the consulting companies. I mean your clients and the people that hire consulting companies. There's more and more that they don't want to do anymore by themselves, and they want to hire experts to do it. And the large consulting businesses recognize that they can't stay ahead of that trend by trying to forecast what's going to be needed in a few years. They're really in the business, in the market of seeing what's popular, seeing what works and what's getting bought, and then acquiring those businesses. So there's a table on the page here that talks about reasons for acquisitions, and I think there's two very strategic, when we think about what are the strategic reasons that companies buy, there's 2 that we like to talk about. And on the axis of how risky they are and how, what the supply of those opportunities are. So building scale and current business footprint is fairly low risk. And expanding the current model by acquiring adjacencies is fairly high risk. And so, you can make sense that, if you're just trying to find more of what you currently do, that's pretty easy to understand. It's easy to execute, fairly low risk. But expanding what you do is very high risk, particularly if it's a significant portion of your current revenue. So if you're buying in a new service area and it represents 50% of the revenue that you do now, it's clear to see that would be higher risk. The other thing I'll tell you, and we provide a lot of content on this, and we just published our annual M&A report. the market for trade deals is very strong right now. The trade buyers, the strategic buyers are very aggressively pursuing deals. So the considerations for a business owner who thinks they might be a candidate for a trade buyer is, really I'll go through these quickly. The synergy case is critical. The why would somebody want to bring you onto their platform? What do you provide that they can't currently do? What are you the final piece of the puzzle for them to really accelerate their own business model within maybe a geography or a certain type of client or a certain sector or a type of service? That's something that we talk about with clients and potential clients a lot. The second, what are the partnership opportunities in the sector? So what as you're thinking about, is a trade deal an opportunity for me? Well, a good indicator of that is, are there a lot of partnership opportunities? Are larger businesses coming to you to help them do something with a particular client? That is a significant indicator that that you would be a candidate for an acquisition, because really partnering with acquiring a business is really a way to guarantee a partnership in the future and control the partnership. And uniqueness, the third, what do I do that nobody else can do? What about your company, your service offering, your sector is unique and would be very difficult for somebody else to replicate? I think having a high uniqueness factor is also a good indicator that there is potentially an M&A outcome for you. The second sort of exit opportunity or outcome that we wanted to talk about is a debt-funded capital restructuring. I think if as we talk to potential clients and interested owners that want to, de-risk what is essentially their investment portfolio, or sometimes called taking some chips off the table, often we talk about the opportunity to restructure through debt. So it is really very simple. It is finding a provider of debt capital to lend you money, and then obviously that allows you to distribute those funds to shareholders. Doesn't change the equity position of the business significantly, but it does allow for a small monetization event. Typically that would be it's a smaller amount of money than you typically see for if you were to sell the entire business. So there are challenges to this. The providers of capital to professional services businesses are specialists, because it's more difficult to apply leverage to a business that doesn't have as many hard assets as you can imagine. And I think you need to think very carefully about when this is the right type of transaction. I think when it's, in my mind, when it's the right transaction is when there isn't a desire to exit the business, when a business owner sees a long trajectory for their continued ownership, and they're comfortable that they have all the tools they need, all the people they need, or the partnerships they need to succeed. They might need a little bit of money to fund growth, and they also might desire to put some money in their pocket as they continue to own the business. And some considerations for a capital restructuring are really it's critical to have high cash flow and predictable cash flow dynamics, a strong balance sheet. The best time to borrow money is when you don't need it. It's very difficult to borrow money in a scenario when you have cash flow challenges, or you need money to continue to operate the business. And long-term ownership goals. Do the shareholders desire a change? Does one shareholder want to increase his or her shareholding, and another shareholder want to decrease? I think a lot of times when we execute debt transactions, it's to facilitate a change in share ownership, so the capital provider is actually funding that transfer or that rebalancing of shares. And so if there is a dynamic where one partner wants to increase and one wants to decrease, that's a good opportunity for this. The third category of exit we'll talk about is a sale to a financial investor. So what we call, private equity firm or funds or financial investors are really those entities in the market that collect funds or raise funds from other investors and apply it by buying operating companies. And as you, I'm sure, know, private equity firms have become a significant player in the market since the 1980s, and are really today one of the largest sources of funding for controlled transactions broadly across the economy. Private equity firms buy professional services firms for the same reason that they buy any firm, because they can take a business, they can apply leverage to it in debt, and they can accelerate their equity returns for their limited partners by growing and then selling the business on to the next owner. I think it's been a challenging sector for private equity. As private equity has developed, a lot of funds have been burned in professional and IT services, and they've made mistakes paying too much money for people businesses. So it's been very cyclical. In my career, I've seen 3 cycles now of private equities aggressively coming into professional services, and then maybe making some mistakes, paying too much, coming out, and then sort of coming back in again. I think what we're seeing now is that there is accelerating interest from private equity firms that have figured it out. And so those funds that have a committed strategy in professional services and know why they're doing it, know what they're doing, and know what makes a people business valuable and what the danger signs are, have become very aggressive in the last 2 years and are sort of back to paying those double-digit multiples in the right situations. But I think that there are certain attributes that are important for private equity in order to really get aggressive with a professional services firm, and that's really what they need is leverage. They need and I don't mean that in the sense of debt. It means that they need something about the business that's unique that they feel like they can accelerate. Maybe that's a software product that the professional services firm uses in their service delivery that can be accelerated. Maybe it's a business model that's being applied to one geography that can be expanded to other geographies. And so it's very important for there to be a leverageable element to a professional services firm that is dissociated from the number of people in the business. So to the extent that a consulting firm revenue is tied strictly to how many people are on the employee list, it makes it a little bit harder to get a private equity to be aggressive. But some specific considerations about a private equity deal are, it's very important to understand the willingness or interest of the management team and the owners to stay involved in the next phase of growth. It's much more common for a private equity fund to invest in a team that wants to stay involved than to invest in a business where the leadership team is leaving. I think growth capital and the need and in this sense, need for growth capital is not a negative, it's a positive. So, private equities want to invest in a story that their money can be used to make the business a lot bigger. And that's, that really requires the ownership team to want a growth partner. Partner in quotes, meaning you're really getting married, and you really need to make sure that the private equity fund that is investing in your business is somebody that you feel like you can work with for the long term. And do we have a growth business here, or do we have a lifestyle business? I think really tied into the desire to grow. There has to be a desire to grow, because a business that is comfortable staying sort of flattish would not be interesting to a private equity. The final outcome that we'll talk about briefly is the stock market listing, or IPO. It's IPOs are also highly cyclical. They follow, the ability to execute an IPO follows the trajectory of the broader stock market. And I think that it really is fairly rare in the professional services landscape, because it really requires a business to be pretty big and a very, very high grower at a very big scale. And frankly, most of the businesses in the consulting and professional services sector get bought before they get that big. So it's fairly rare. I mean, I think you're talking about multiple hundreds of millions of revenue and really sort of 20-25% growing. And I think that the IPO market is really a much better outcome for a little bit of a different, much more highly leveraged sort of technology and product businesses than necessarily people businesses or professional services. So we don't see this as much in our sector. The overwhelmingly most common outcome in what we do at Equiteq is a strategic deal. So an entrepreneurial, a founder-owned professional services, IT services business being growing to a certain point at which they recognize the need for a partnership for that next phase of growth, and finding a strategic outcome. That is overwhelmingly the most common outcome. So Paula, I think that's the extent of the prepared content. I would be happy to pass it to you to ask some of the questions that have come in.
Thank you very much, David, and thank you to all of you who have posted in questions. We're going to try to answer as many of them as we possibly can, and if we don't get to them all, we'll get back in contact with you personally. So a question that has been posted for you, David, is will trade buyers ever buy a minority stake in a professional services business?
Yes, they will. I think it's a fairly common desire because it is a way for them to have a certain amount of control without the risk of the full outlay of cash. I think it's something that rarely works in practice because it's very difficult to align the interest of the investor with the interest of the owner in that scenario. And frankly, from our perspective, the danger is that it limits the opportunity later. It limits your flexibility later if you decide to take the business in a different direction, because you've got a powerful and significant industry player who's got a seat at the table. So it is fairly common as something that a strategic wants to kick the tires on, but in what we do, it's fairly uncommon to see it actually work in practice.
Thank you. And another delegate has asked, what are the global companies looking for?
Well, it depends, obviously, but I would say the single thing that we find we hear a lot is what I call focused scale. So obviously it's going to depend on the specific sector and business model of the individual buyer, but what they're all telling us is that they want sizable businesses that are easy to integrate. And so what do they mean by sizable? When we do our annual buyer's research report, we find that the large global buyers are typically looking and want businesses that are in between that $20 to $40 million revenue range. That's what they most want to buy. But they want it to not be too diversified. So they want it to be pretty sizable, but not have offices in multiple geographies, or not be not sort of be diversified across sector too much. They want really focused scale. And that is the most sort of common, I think, denominator that you'll see across the global buying community. And other than that, it's really just the advancement of their business through buying things that they can't otherwise build. They recognize that they just can't build everything they need to grow fast enough and to stay relevant to their clients. And so plugging in those pieces that allow them to do something that they couldn't do before is really what makes deals happen.
Thank you, David. Another question, is there a revenue level that begins to achieve a higher EBITDA multiples at purchase?
Not in isolation. I think the achievement of a high multiple is difficult to ascribe to any one factor. I don't think that if you had perfect information about every deal done, I don't believe that there would be a high correlation factor between scale and multiple achieved. I think that scale can make it more likely to achieve an outcome. I think it's on everything, all else equal, it's easier to sell a $25 million business than a $4 million business. But I don't think that you'd see a high correlation or a sort of a step function at a certain revenue size to EBITDA multiple as a general rule.
Okay, thank you. And what are the valuation differences between a trade sale and a private equity sale?
Well, there aren't necessarily any, and that's a cyclical consideration. So when you think about the emergence from a down cycle, the strategics typically come to higher valuations faster than the private equities do. and then the private equities catch up. So right now, we're, as a rule, not seeing a tremendous discount amongst the private equity community when compared to the strategics, or if there's a similar amount of interest in the business. So it doesn't have to be really any mechanical difference in the valuations. I would say that you'll typically see structural differences where the a private equity will require the management team and the owners to roll into the next vehicle and sort of maintain a significant stake and shareholding, and the strategics will align incentives around sort of an earnout or a holdback. So you get a lot of structural differences. The deals feel very different. The incentives are different, and the partnership is different, and there's a lot that's different about the deal. But you don't necessarily need to assume that one deal is done at a premium to another in an active market like we're in today. You can find very similar valuation philosophies amongst either, depending on how attractive the asset is.
And another valuation question for you: what are valuations like for professional services firms?
Well, we look at that every year and constantly, and it's very interesting topic, because it's one of those analyses that it's very easy to misunderstand. And so when we look at the aggregate market, the overall valuation guidance, if you had to pick a number, in the general case, is somewhere around 1x revenue. But the only thing that if you apply that to any specific situation, is that you're wrong. You just don't know how wrong you are. And so every company has its own value, and every process and every deal has its own sort of dynamic to assigning value. But we see overall and over many years that for a traditional consulting business, anywhere somewhere around 1x revenue is a reasonable place to start when you're thinking about value. But in a good market like we're in today, the deals we've closed recently, the last 6 or 7 deals we've closed, have all been closed well above that. And we're seeing high synergy cases and high valuations applied. So I think it's one of those things that all depends, and I think it's an area where we apply a lot of specific expertise. I mean, that's where a lot of Equiteq's IP is in applying our proprietary valuation methodology to specific situations. So it's very difficult to apply general metrics to any specific business. I think it's a dangerous way to think about it, because you really need a specific advice to understand what your business might be worth.
And I think we've got time for just one more question, David, if you don't mind. What are lenders using as a security for providing debt in this sector?
Well, the best case is if you've got an identifiable asset, like a piece of software, or some other asset on the balance sheet. But other than that, I think it's comfort with the cash flow and the receivables and the dynamics of the business. I think it isn't a sector where you can achieve high leverage ratios. So in a business that really has an asset base that consists mostly of AR, it's all about predictability, growth, contracts, and the specific dynamics of the business. It's not the easiest sector to lend into, frankly. So you really need a lender who understands the sector, who's experienced in professional services, and can get comfortable with the client base and the dynamics of the business.
Thank you, David. That's all we have time for. If you posed a question which we didn't have time to answer, then we will get back to you after the event. And if you'd like to discuss the webinar or any aspect of your plans to sell, please do not hesitate to contact myself or David. You can contact me at paulaallerton@equiteq.com. If you aren't already a member, then please do join our Equiteq Edge Club. It's a free source of information for consulting firm owners looking to realize equity value in their businesses. You'll find expert guidance, unique research, guest articles, and lots more, including a monthly newsletter. So finally, thank you to David for a very insightful presentation, and thank you to everyone for attending. Again, I apologise for the earlier distortion on the webinar, but hopefully you heard enough to help you in your exit plans. A recording of this webinar will be available within 24 hours, and we will be sending you a link. Finally, if you have any questions or comments, please feel free to contact us. We'd love to hear from you. Thank you for your time. Thanks for joining.